This lecture is about job order costing. We will discuss the allocation of manufacturing costs to factory output in those situations where the goods produced are not uniform. These costs include materials, labor, and overhead. If you think of manufacturing operations as a continuum, on one extreme you will find assembly line work where everything that a firm produces is the same. In these instances, we assume that the cost to make a unit is the average cost of all of the units. Because all of the units are the same, we assume that their individual costs are equal. This type of operation uses process costing. On the other extreme, you have an operation where everything that the firm produces is unique. An example of this type of operation would be a film studio, where the cost to produce each film is different. This type of operation uses job order costing. Between the two extremes, you find operations that produce goods that have common elements, which requires the use of process costing, but part of the goods are also dissimilar, which requires the use of job order costing. An example of this would be a sofa manufacturer that produces chairs with a common frame, but each chair has a different fabric and stuffing chosen by the customer. This type of manufacturing requires the use of operation costing. In this lecture, we will discuss job order costing. Generally, all of the costs that a firm spends to obtain its inventory and to get those goods ready to be sold are treated as the cost of that inventory. In the manufacturing context, that rule results in all of the costs of a factory being treated as the cost of the inventory that the factory produces. Generally, nothing in the factory is expensed. The cost of the inventory that a firm produces is made up of three components. These components are direct materials, direct labor, and manufacturing overhead. Direct materials are materials that become part of the product produced. The cost of wood that becomes part of a chair that firm produces is an example of a direct materials cost. Any other materials that a factory uses in its operations, but that do not become part of the product itself, are indirect materials. The sandpaper that the firm uses to make the furniture would be an example of an indirect materials cost. Direct labor cost is the cost of labor that actually produces the goods manufactured. The cost of the carpenters that produce the chairs that our factory makes would be an example of direct labor. Any other labor cost incurred by the factory, where the workers do not actually produce the goods made, is indirect labor. The cost of supervisors or maintenance workers is an example of an indirect labor cost. Any factory cost that is not direct labor or direct materials is manufacturing overhead. Examples of manufacturing overhead include the cost of a factory's rent, utilities, insurance, property taxes, depreciation, indirect materials, and indirect labor. As noted above, job order costing involves non-uniform goods. Because these goods differ from each other, their cost differs as well. Because they have different costs, their manufacturer must keep track of the cost of each job or order. We will now review the mechanics of job order costing, and how a firm keeps track of those costs. With job order costing, a firm must keep track of the cost of each job or order that it receives, hence the name, job order costing. In order to do this, a manufacturer keeps a job cost sheet for each order. On this sheet it keeps track of a job's material, labor, and overhead costs. The example before you is the job cost sheet for job 2B47. A record is kept every time that the factory draws down materials. That record is called the materials requisition form, and it notes the job or account that is charged for the materials being requisitioned. The materials requisition form has a number so that it can be traced. On the example on the screen, Materials Requisition Form 14873 notes that the materials being used are being charged to Job 2B47. After the materials are requisitioned, the materials requisition form is sent to the bookkeeper, who will note that Materials Requisition Form 14873 contains a materials charge of $660 for Job 2B47. This charge is highlighted in yellow on the slide. A timesheet or ticket is maintained for each worker. The time spent on each job or account is noted on that record. Each timesheet is given a number so that it can be traced. In our example, Time Ticket 843 notes that Mary Holden spent 5 hours working on Job 2B47 for a cost of $45. Again, the timesheet or ticket is sent to the bookkeeper, who notes that Time Ticket 843 contains a $45 labor charge for Job 2B47. This charge is highlighted in red. This slide shows that Job 2B47 is also being charged $216 for manufacturing overhead. There is no separate document, similar to the time ticket or the materials requisition form, that notes the incurring of the overhead charge. That is because there is no way to measure overhead that a job incurred. Instead, firms have to estimate the amount of overhead that should be charged to an individual job. On the slide, this firm has decided to apply overhead at a rate of $8 for each direct labor hour spent on a job. This charge is highlighted in green. You will note that the direct labor column on the job cost sheet notes that Job 2B47 had 27 direct labor hours, and you will note that 27 hours times $8 per hour gives you the $216 of overhead that was charged to Job 2B47. We will now discuss the journal entries made by a firm for the manufacturing costs that it incurs in a job order costing system. This slide gives you a brief overview of the accounts used in a job order costing system. When raw materials are purchased, their cost is added to a materials inventory account. When direct materials are requisitioned, their cost is transferred from the materials inventory account and added to the work in process account. This transfer is represented by the teal or blue-green arrow. Work in process is an inventory account where the costs of incomplete jobs are kept. When indirect materials are requisitioned, their cost is transferred from the materials inventory account and added to manufacturing overhead. This transfer is represented by the green arrow. Manufacturing overhead is a temporary account that will not appear on any financial statement at the end of the year. When direct labor costs are incurred, they are charged directly to work in process. This charge is represented by the brown arrow. When indirect labor costs are incurred, they are charged to manufacturing overhead. This charge is represented by the red arrow. When any other factory cost is incurred, it is charged to manufacturing overhead. This charge is represented by the magenta arrow. Periodically, all of the costs that are being accumulated in the manufacturing overhead account are transferred or applied to the jobs in the work in process account. This transfer is represented by the orange arrow. As jobs are completed, their cost is transferred from the work in process account to the finished goods account. This transfer is represented by the blue arrow. Finished goods is also an inventory account. The cost of the goods completed in a given period is referred to as the cost of goods manufactured. When goods are sold, their cost is transferred from the finished goods account to the cost of goods sold account. This transfer is represented by the pink arrow. Please remember that generally, no factory cost will be expensed. When you do a journal entry for a factory cost, you should begin with the journal entry that you learned in your financial accounting courses. If, however, you should see an expense, you need to change this account because generally no factory costs will be expensed. Let's begin with factory depreciation. In your financial accounting courses, you were taught to debit depreciation expense and to credit accumulated depreciation. But, you know that generally you won't have expenses in the factory setting. So, you have to change the debit. What should you debit? Is depreciation direct materials? No. Is depreciation direct labor? No. Any factory cost that is not direct materials or labor, must be manufacturing overhead. So, you should debit factory overhead and credit accumulated depreciation. Consider the journal entry that a factory would make when buying raw materials. In financial accounting, when you purchase inventory on credit, you debit the inventory account and credit accounts payable. That journal entry does not contain an expense account. So, nothing needs to be changed. Consider the journal entry made when a factory requisitions direct materials. Where are direct materials going? If you remember the cost flow diagram that we discussed earlier, 3 things go into work in process. Anything with direct in its name goes directly into work in process. Every other factory cost goes first into manufacturing overhead, and then, eventually, it is applied to work in process. So, we want to transfer direct materials directly into work in process, as is indicated by the teal or blue-green arrow. Thus, you are transferring an amount from one asset account to another asset account. In financial accounting, you would debit the asset that is increasing, which is work in process, and you would credit the asset that is decreasing, which is materials inventory. That journal entry does not contain an expense account. So, nothing needs to be changed. Consider the journal entry made when a factory requisitions indirect materials. Where are indirect materials going? Anything with direct in its name goes directly into work in process. Every other factory cost goes first into manufacturing overhead, and then, eventually, it is applied to work in process. In other words, everything else goes indirectly into work in process after first going into manufacturing overhead. Because indirect materials does not have direct in its name, it goes into manufacturing overhead, as is indicated by the green arrow. Although manufacturing overhead does not appear on a balance sheet at the end of the year, it behaves like an asset. Thus, you are transferring an amount from one asset account to another account. In financial accounting, you would debit the account that is increasing, which is manufacturing overhead, and you would credit the asset that is decreasing, which is materials inventory. That journal entry does not contain an expense account. So, nothing needs to be changed. Consider the journal entry made when a factory incurs a direct labor cost on credit. In your financial accounting courses, you were taught to debit some sort of labor expense account, such as wage expense, and you were taught to credit some sort of payable account, such as wages payable. We know, however, that you generally do not expense factory costs. So, we need to change the debit. Where do direct labor costs go? Anything with direct in its name goes directly into work in process. So, we know that we have to put direct labor directly into work in process, as is indicated by the brown arrow. Thus, we debit work in process. Consider the journal entry made when a factory incurs an indirect labor cost on credit. In your financial accounting courses, you were taught to debit some sort of labor expense account, such as wage expense, and you were taught to credit some sort of payable account, such as wages payable. We know, however, that you generally do not expense factory costs. So, we need to change the debit. Where do indirect labor costs go? Because indirect labor is not a direct cost, it must go indirectly into work in process, after first going into manufacturing overhead, as is indicated by the red arrow. Thus, we debit manufacturing overhead. Consider the journal entry made when a factory incurs a utility cost on credit. In your financial accounting courses, you were taught to debit some sort of expense, such as utility expense, and credit some sort of payable account, such as utility payable. We know, however, that you generally do not expense factory costs. So, we need to change the debit. Where do utility costs go? Because utility costs are not direct costs, they go indirectly into work in process, after first going into manufacturing overhead, as is indicated by the magenta arrow. Thus, we debit manufacturing overhead. Consider the journal entry made when a factory pays its rent in cash. In your financial accounting courses, you were taught to debit some sort of expense, such as rent expense, and credit cash. We know, however, that you generally do not expense factory costs. So, we need to change the debit. Where do rent costs go? Because rent costs are not direct costs, they go indirectly into work in process, after first going into manufacturing overhead, as is indicated by the magenta arrow. Thus, we debit manufacturing overhead. Consider the journal entry made when a factory pays a prepaid expense, such as prepaid rent. In your financial accounting courses, you were taught to debit prepaid rent and credit cash. There is no expense in this journal entry. So, nothing has to be changed. When the rent is eventually accrued, then you were taught to debit some sort of expense account, such as rent expense, and credit prepaid rent. We know, however, that you generally do not expense factory costs. So, we need to change the debit. As we noted earlier, because rent costs are not direct costs, they go indirectly into work in process, after first going into manufacturing overhead, as is indicated by the magenta arrow. Thus, we debit manufacturing overhead. As you will recall from our factory cost flow diagram, all non-direct factory costs are accumulated in manufacturing overhead, and then, eventually, they are applied or transferred to work in process, as is indicated by the orange arrow. The journal entry made when you apply overhead requires a debit to the asset being increased, which is work in process, and a credit to the account being decreased, which is manufacturing overhead. When we finish a job, we transfer the cost of that job from work in process to finished goods, as is indicated by the blue arrow. We debit the asset that we are increasing, which is finished goods, and we credit the asset that we are decreasing, which is work in process. When we ship a job to a customer, we transfer the cost of that job from finished goods to cost of goods sold, as is indicated by the pink arrow. We debit the account that we are increasing, which is cost of goods sold, and we credit the asset that we are decreasing, which is finished goods. We are now going to discuss applying manufacturing overhead to the products that our firm produces. You can't measure how much overhead goes into a particular product. For example, how would you measure the amount of rent or depreciation that goes into a chair that you are producing? Because of this, we assign a proxy that we measure, which will take the place of manufacturing overhead. We call this proxy a cost driver or cost base. The most popular cost drivers are based on labor, such as direct labor hours and direct labor cost. There are many other drivers, such as machine hours and units. Even when using cost drivers, it is difficult to assign actual manufacturing overhead costs to the units that you produce without some sort of estimation. After all, how do you apply this month's electricity or heating costs to the units that you produce this month when you won't get your electricity or heating bills until after the month is over? Besides the problem with the delay in knowing your overhead costs, there is another problem. Your overhead costs can vary greatly from month to month due to such things as business seasons and the different weather that you experience during the year. For example, consider a toy factory in New York City. Most toys are sold at the end of the year, and our toy factory's production reflects the seasonality of its business. Moreover, New York City is notoriously cold in the winter and hot and humid in the summer. The slide shows you the manufacturing overhead and units produced for our toy factory. In April, when the weather is nice, the overhead costs are $50,000. Because the factory has not yet geared up for the holiday rush, it is producing 40,000 units. In July, when the factory is using a lot of air conditioning, its overhead costs are $70,000. Because the factory is working overtime in order to ensure that it meets its holiday orders, it is producing 80,000 units. In January, when the factory is incurring a great deal of heating costs, its overhead costs are $60,000. Because there is not a lot of demand for its toys at this time, it is only producing 20,000 units. If you divide the overhead costs for each month by the units produced during that month, you will see that the overhead costs per unit vary wildly. No firm wants its inventory costs to vary that much during a year. It will disrupt its income reporting. Many companies will try to avoid wild swings in their inventory costs, and smooth out or normalize these costs. They do it by applying a constant rate of manufacturing overhead to the units that they produce. Firms do this by calculating a predetermined overhead rate at the start of the year, and using that rate for the entire year. The predetermined overhead rate consists of the estimated total overhead for the upcoming year divided by the estimated amount of the cost driver for that year. For example, assume that a firm expects to have total manufacturing overhead for the upcoming year of $300,000. Assume also that the firm has chosen to use direct labor hours as its cost driver, and it has estimated that it will have 100,000 direct labor hours in the new year. When you divide 300,000 by 100,000, you get a predetermined overhead rate of $3 per direct labor hour. Our firm will apply overhead to the units that it produces using that rate during the new year. For example, if a job has 10 direct labor hours, the firm will add $30 of overhead to the cost of that job. When a firm charges a job for its actual direct materials, direct labor, and manufacturing overhead, it is called actual costing. When a firm charges a job for its actual direct materials and direct labor, but applies overhead using a predetermined overhead rate, it is called normal costing. When you use normal costing, you know that your predetermined overhead rate is based on estimates, and the actual result is very likely to be somewhat different. The difference between the amount of overhead applied and the amount of actual overhead is called the manufacturing overhead variance. Consider the example on the slide. The firm actually incurred $100,000 of overhead during the year, and placed that overhead in its manufacturing overhead account. During that year, using a predetermined overhead rate, that firm applied $90,000 of overhead to the units that it produced, and it transferred that amount to work in process. At the end of the year, there is a debit balance of $10,000 in the manufacturing overhead account. Because the firm did not apply enough overhead to the units that it produced, we say that the overhead was underapplied. We have to close out the manufacturing overhead account, and we need to correct our mistake. But where did our mistake end up? If the amount of overhead that we transferred to work in process was $10,000 short, then the amount passing through work in process is off by $10,000. If we completed the work on all of our jobs, and transferred their cost to finished goods, then the amount passing through finished goods is $10,000 short. If we delivered all of our jobs, and transferred their cost to cost of goods sold, then the amount in cost of goods sold is $10,000 short. So, we know, ultimately, our mistake will end up in cost of goods sold. Because of this, when we close out the manufacturing overhead account, we can transfer the underapplied overhead to cost of goods sold. In our journal entry, we first do what we need to do to zero out the manufacturing overhead account. Because the manufacturing overhead account has a debit balance, we need to credit it for $10,000. You then add cost of goods sold to the other side of the journal entry. If instead, your firm had incurred manufacturing overhead of $90,000 and applied $100,000 of overhead to the units that it produced, the overhead would be overapplied by $10,000. In our journal entry, we first do what we need to do to zero out the manufacturing overhead account. Because the manufacturing overhead account has a credit balance, we need to debit it for $10,000. You then add cost of goods sold to the other side of the journal entry. The end.